everybody. We'll open the meeting and call to order. Motion to adopt the agenda.
So moved.
Second.
Any discussion or questions? Seeing none, all those in favor say aye.
Aye.
All those opposed, the same. Chair votes aye. Approval of the December 14th minutes. Has everybody had an opportunity to look at those?
With adoption of minutes as presented.
Second.
It's been moved and seconded. Any discussion? Seeing none, all those in favor say aye.
Aye.
All those opposed, the same. Chair votes aye. Public comment. This is an opportunity for the public to comment on any matter that is not on the agenda of the meeting and is within the jurisdiction of the teacher retirement system and board. However, the board may not take action on any issues raised unless it's included in our agenda and public comment has been allowed on that. If issues raised require board action, the issue would need to be included in the agenda for further review. Public matter does not include disabilities or contested cases or adjudicated proceedings. Now that I've got that out of the way, do we have any public comment? Okay. Next agenda item, Board of Investments Annual Report. Officer Cullen, good morning.
Good morning.
Thanks for coming, Joe.
Mr. Chair, members of the board, thank you for the opportunity to sit with you today and review the TRS investment portfolio and the year 2018. We should have plenty of time on the agenda, so as I go through the presentation, which I believe is in your materials, please stop me at any point with questions or clarifications that I can give. So page 3 just has a table of contents that we're going to go through, but I'd really like to start on page 4. Just as a reminder what influences us at the Board of Investments every day as we're thinking about managing your assets. And the key words on this page are the prudent expert principle, and that's kind of defined in the 3 points below. You know, we're discharging the duties with care, skill, prudence, and diligence. We're diversifying the assets, and to sum it up, we're investing the assets solely in the interest of the beneficiaries of the fund. So solely in the interest for the participants in the TRS plans and the other retirement plans that we manage. Our objective is to achieve over the longer period of time the actuarial return that you set for the plan. I believe that's currently 7.5, very long-term number, and that aligns with our long-term focus at the board to achieve that number. Shorter time periods, we're also assessing our performance relative to industry standard benchmarks, and to a lesser extent looking at peers. The reason I say to a lesser extent, it's quite often not really comparable. Although there might be other pension plans and there might be other government-related pension plans, their situations and their approach may be very different. So we're mainly focused on that 7.5% actuarial return and trying to achieve that over a long period of time. Any questions on the goal? Page 5 has the organizational chart. No real changes to the actual functions here described since I think the last time we met. I think there's a total of 32 positions. We're led by a board of 9 members, including Mr. Greenfield, and we have a new chair as of this year, Carl England, who has been a member of the board for a number of years. We also, over the last few months, have a new executive director, Dan Villa, who's not new to the state, but new to the Board of Investments. And so much of the other team has been there for a number of years, quite a few years. I joined in 2015, and I'm one of the least tenured ones there. So there's a lot of history at the board. If I could ask you to turn to page 6, just want to quickly review asset allocation. This is, asset allocation is just the topic of how we decide what type of investments we're going to have within the portfolio and how much we're going to allocate them. It is probably the most important decision we make because it really determines the amount of risk that we're going to have in the plan and therefore the chances for long-term performance. Unfortunately, the more risk you take, that's what drives performance, and so we need to manage risk. We can't have an exclusive focus to avoid risk. So asset allocation is the primary driver of returns, and how we think about that, we use the word capital market assumptions. That's just saying we look at cash, bonds, equities, and all their variations, public and private, and break it down into a lot of different segments and come up with a looking forward in time and come up with an estimate of what we think that return will be and how volatile that return will be. And therefore, we try to take those asset classes and put them together in a portfolio to, over time, achieve that longer-term actuarial return, but also help reduce the volatility. So it's not like we're saying, oh, what are going to be the best 3 performing asset classes over the next 10 years and put the entire portfolio in those 3. We're picking asset classes that will include lower performing asset classes, partly because they have lower risk profiles. So it's really driven by that overall goal. The more volatility we have, which is something, I think the last time I was here, we hadn't seen much volatility recently. It has kind of shown up again in a significant way, especially with the fourth quarter of last year, and we expect more of this year. So it is something we're comfortable, we're used to managing, and it's just kind of part of what we need to do, but it's a key reason why we focus on the longer term. I'll show some information later how volatility and returns kind of narrow the longer the time period you're thinking about. So it can be helpful in our role, not to really turn on the news some days and read the weekly papers and stuff like that, because there can be a lot of noise, and so we focus on the longer term. The other key thing is we're thinking about liquidity, because that's critically important, because that's how liquidity is basically saying cash. That's how we pay the benefit payments, which is why the plan exists. But we want to make sure there's always enough money there to pay that when you need to do so. But we never want to be forced to sell assets at kind of a disadvantaged time, when assets maybe have gone down recently to pay those benefit payments. So as we'll talk a little bit later, your portfolio is really 2 pieces. There's a cash piece invested in STIP and more kind of longer term focused on what we'll call CAP, a consolidated asset pool that has all of the other assets. So liquidity is a key thing, and as you do your actuarial studies and come up with expectations about benefits over the next 10 years or so, we get information from you all, and we incorporate that, so it's an important aspect. There's not one right way to do asset allocation. There's not like you say, oh yeah, that's right, 100%, great. There's a lot of different ways to approach it, and so before we come up with our asset allocation, we consider a number of those different ways. Some are more mathematical, and some are more qualitative in nature. We like to combine those different methods to arrive at the asset allocation ultimately in the portfolio. On page 7, more on asset allocation and some of the things that we're thinking of. The first bullet already talked about that, but the liabilities are a key thing. That really defines the objective. You know, what is the actual return, what's the liquidity that needed, so that's what is the funding status. Those are the characteristics of the plan that you share with us that we take into account. But also as important on the investment side, what is the opportunity set and what do we think about that? Currently, as we look at that, and I'll talk a little bit more about this later, as we put that all together and we look forward at intermediate time period, not as long as the actuarial return, but we come up with numbers that are more in the mid to high single digits, but probably slightly below the current actuarial return. As I'll talk more later, not necessarily a problem in itself, because we're only looking forward like 10 years, and you and your actuaries are looking forward 40 or 50 years, so a lot can happen over that time frame. We do look at asset allocation formally with our board at least annually, and we might just confirm it and make no changes, or we might make significant changes. In the past year, November 2018, we made very incremental changes which are incorporated in this last bullet here. Basically, we made small adjustments to increase our exposure to fixed, to increase the range of within the asset allocation, the ranges with some of the fixed income, and a slight decrease to cash within cap itself. So nothing meaningful, no really big picture change. This slight increase in fixed income, if we were ever to see interest rates continue to rise and go up meaningfully, I would expect this process to continue over time, because think of if we ever got back to what some people refer to, although they no longer seem like normal interest rates, right? Now, in kind of the mid-single digits, well, that would get us a lot closer to that 7.5% actuarial return, and so likely those would play a bigger part in the portfolio. But today, as we'll see later, they're about 25% of the portfolio, but would increase the range slightly. Any questions about asset allocation? Yes?
Did the changes in these ranges result in any changes in actual allocation, or just in the?
Not really. We had increased some of these things, like the first bullet here, 2% increase to the top range of U.S. TIPS. TIPS, that stands for Treasury Inflation Protected Securities, so it's a fixed income bond note issued by the U.S. government. We had been increasing in that a little bit because generally the marketplace has very low expectations of inflation, and if the market were to be surprised, these tips should do pretty well. So we had increased that, we had gotten close to the top of the range, and so not right at it, but we increased it to allow greater flexibility as going forward. So it was more not saying because we were forced, we needed to do it, but just thinking as fixed income has become a little bit more attractive over the last year, and as we have increased concerns, as we'll talk about later, about the growth of the economy and the pricing of some of the equity, we wanted to just increase fixed income. But it wasn't immediate, take these fixed income asset classes and then go to the top of the range. Any other questions on asset allocation? So page 8 is really, and teachers, kind of the second line here. Again, this is just, we'll get to it later in the appendix. There's a monthly report, and I want to make sure as you get that, if you have any questions, we can review that. But the key thing is for your portfolio, there's really 2 allocations. One is to STIP, the short-term investment pool. That's really the cash liquidity buffer, and at the end of the year, we had about 2% in that. The other 98% of the assets were in CAP, this consolidated asset pension pool, which has all of the other assets, and actually includes a little bit of cash inside of that too. But as you see from this page, we included all the other pension plans just to confirm that we're managing the assets across all the pensions in the state in a similar manner. And then page 9 shows the actual asset classes we have, and this is for CAP. This isn't just for your portfolio in terms of the market value here. So this is all the pensions combined as of 12/31. But the percentage of the total in the board approved ranges are the same basically for the TRS portfolio, because every one of these pensions that invest in CAP gets the same percentage and has the same ranges. So it's just a confirmation that where we were at 12/31 and where we have been and where we expect to be are within these ranges, right? So we're monitoring that on a daily basis. If we turn the page to page 10, the performance page, I purposefully on this page, and as I presented the same page to our board in the last few days, we don't put a quarter return, because sometimes you're gonna have a quarter like we did the fourth quarter of 2018, and then a lot of people start panicking and saying, oh, what are we gonna do, what do we need to change? And this is a good example. You see the 1 year number now of, okay, minus 2.64 for the teacher's plan, below what we would hope for, any negative number is, but not unreasonable, not necessarily unexpected for a shorter term year, and not like a huge negative in terms of creating a real detour for us to achieve the longer term goals. So the minus 2.64% for the year was driven by the fourth quarter negative return. But it's in line with what we would expect in any one year. As you move further to the right, you'll see the 3-year, and all these numbers would include the 1 year number. The 3-year number a little bit higher, 5-year, they're kind of mid-single digits. The 10-year number, because now we've gotten rid of all those problems from 07 and 08, those have rolled off, and so the 10-year number in the high 8s. The 20-year number includes those problems 07 and 08, and actually still includes the problems from the internet bubble in 2000. So that's why it's below. The longer term number, which still, I'll point out the 24 years, a long period of time, but still only about half the time that you think about from an actuarial time horizon. And so consistent, but the trend is, the numbers have come down a little bit, right? And the biggest challenge there is fixed income, because the last decade fixed income rates have gone lower, and so now as we go forward, they're providing a little bit less of a return for us. Again, not a huge issue for us to deal with. We have greater weightings and equity in the portfolio, but it is something probably over the next 5 or 10 years, in the last 5 years, that have brought down the overall returns. Because fixed income is a part of the portfolio. Any questions here on the numbers itself for the plan?
Just to point out that 1 year, that's calendar year, so it's through December 31st.
Yes.
And in fact, some of that has come back already.
Yeah, so I'll talk about that a little bit later, give you some more up-to-date numbers and context for that. But yeah, sorry, this whole presentation, everything I'm talking about, the information is as of 12/31, and it's a 1 year review as kind of required and part of the presentation from the year. Page 11, I think, is always interesting to look at, just look at the colors, don't even try to read the words, but you see things jumping all over the place. I'll take you through the first column, and that will help you understand some of these things, but the first column, the 1 year, again, the calendar year 2018, that purple box, it says LIBOR 1 month, that's an index as a proxy for cash. So cash was the best place to be in calendar 2018. The next 4 boxes that say, next 5 boxes that start with BARC, that's for our Barclays, Bloomberg, kind of fixed income indices. So all of those are investment grade fixed income indices. Where it says PERS, put TRS in there in your mind. This is a slide I just pulled from our board materials, but your numbers are right in line there. And that's one thing I'll even point to these other columns. Our expectation over time is that your number will be somewhat in the middle. Hopefully in longer periods of time, closer to the top of these columns, but we will never really expect it to be at the top, and hopefully never at the bottom, right? Because we are using different asset classes, and each of these boxes represent the different asset classes in the portfolio. So we expect it to be somewhere in the middle, and so that's where the 2018 calendar year number fell. And then as we go below that, you'll see our US HI, so that's high yield fixed income. So a little bit more risk than investment grade, and given that risk didn't really pay you that much in 2018, that didn't do as well as the better quality investment grade. And then we go, the red is real estate, and that's real estate equities, but public real estate equities, REITs. Then below that we get to broader US equities, and then, which is dominated by the large caps and mid caps. And then we specifically point out the small caps in the blue, small cap US equities. And then we get to natural resources, which is dominated by oil, but also includes other things within that. And we think of, our portfolio is primarily today energy-related exposure and timber in that part. And then lastly, the worst performing asset class from a benchmark standpoint over the calendar 2018 was all equities, public equities outside of the United States, so the non-US equities. And you'll see over the 5-year, that was second from the bottom, over the 5-year period, kind of these natural resource commodities have been at the bottom. So it was clearly a year that sometimes you'll hear in the press as a risk-off year, right? So anything that you would expect should do well over a longer period of time in 2018 did not do well. But we have a mixture of asset classes, because you can see there's not a lot of steadiness in terms of where these things might fall in each of the columns. Any questions about this page? Or? Okay, if I could take you to page 12, and really the second line, to focus on your plan there, this is just to show the change, right? At year over year in terms of dollars, and you'll see that the dollars, the far right column, second row down, there was a decrease of a little bit more than $255 million, right, and over the calendar 2018. Now, of that amount, 110 million was because of this negative market movement, approximately. 145 was not necessarily a bad thing, but it was we were paying benefit payments, which is the whole reason for the plan, right? And so, but the 110 million was connected to that, minus 2.64% decline in the market. So the assets did go down. I didn't include it here. We reviewed it with our board, but if you look over a 5 or 10 year period, you would have seen the change, including 2018 over the last 5 or 10 years, assets have increased because although 2018 was was a challenging year. The 5 and 10-year period, the investments have given a return and allowed the assets to grow above the benefit payments that have been kind of pulled up. Any questions there? Page 13, there's a lot going on here, so I'm going to spend a few minutes here, but one reason for this presentation is to give you a sense of, well, how we've done versus peers. You know, that's kind of one of the requirements. But I'd also ask you to take it in, but, you know, again, as I said at the beginning, it's a challenge sometimes to compare. What you will see is the difference in returns is largely explained by their difference in asset allocation. And so the key line to look at here, you know, the teacher's retirement in this top chart are kind of in the bottom 2 sections. Teacher's retirement net, that means it includes all the investment fees in the performance numbers, and gross is really before fees. And it's that gross number that is usually used in comparison against peers. Because the larger you are, the benefit you get from lower fees. That's just how the cost of investment management. So to say, well, how did the investments do themselves in the structure? It's a little bit more comparable to look at gross terms. So I'll ask you to focus on that. And so if you look at that line, teachers' retirement gross, and you see, for the quarter, you know, we were down minus 6.71, and for the year, minus 2.03. If again, just to explain the difference between net and gross, if you go a few rows above that, you'll see that minus 2.64 number I already referenced. So the difference between those numbers are really the cost to manage all these assets. But the minus 2.03 compares to this peer group, and sometimes it's an art choosing kind of what peer group. This slide comes from the Board of Investments independent consultant RVK, and they define the group as those public plans greater than $3 billion in assets, pension plans. And you'll see that kind of written out in that dark gray line. But if you use that 1 year number, or minus 2.03, the minus 2.79 for the plans on average, put us a little bit better in the median or the 44th percentile. So the lower that number is, then the better your ranking is. Whereas if you look at the quarter, where our number was minus 0.671, and the plans did, on average, these peers, minus 5.97, we were in the 70th percentile. So the higher the number, you don't want to be there, right? Because it means your performance is not as strong as others. The good thing, though, is over the 1 year, okay, in the top half, but as you look at longer time periods, the 5 year is 16, the 7 year is 5, the 10 year is 13, right? So the trend for the last decade has been strong relative to peers, but again, I don't want to emphasize that too much and pound the table and say we've done great, because I'm not sure how relevant it is, you know, given all the other peer circumstances. And so there will be times, like the fourth quarter, that for whatever reason, our returns are lower than the peers. And I guess that reason can usually be described because of the different asset mix. And that's what's in the bottom table on this page. So let me try to walk you through that. So the first column here is U.S. equities, and you'll see the 30.98 number. So that means we had about 31% within this cap pool in U.S. equities. And then that 19 next to it in brackets is saying that put us in the 19th percentile. So again, it's confusing, but lower here, the lower that number, the more we had relative to the median. And that's a little bit easier to see. If you go down a few rows, you see the quartiles mentioned, and right in the middle it's median. So the median public plan in this peer group had 23.64% to US equities. So we had approximately 7% more in US equities. And that hurt during the fourth quarter. But that was the biggest driver over the last 10 years why we've done better than most plans, right? And I'll quickly kind of review, kind of going across here to the right, the other asset classes. International equity, you know, we're at the 65th percentile at 16.5, so a little bit less than the median of 17.94. Fixed income, a little bit more, 26 compared to 23. International fixed income, we don't have any, so less. Alternative investments, you know, it's probably important to describe what this is. For us, it's generally these private equity investments we're making and what we call natural resources, which also tend to be, have a fair amount of private, longer-term investment vehicles in investing in timber or energy. For most of this peer group, this also includes hedge funds, which also are longer-term vehicles, less liquid. We don't have that type of exposure in the plans, so that's an area that why we might actually have more private equity than some, but the median is at 20%, we're at 13%. I'm roughly guessing that the average plan probably has about 10% in hedge funds, and we have 0. So that's the other driver here for our differences in asset allocation. So our decision basically has been over the last 10 years to not own hedge funds and own the US equities. Hedge funds generally go long and short, so they're a little bit less market exposure. Our US equity is 100% long kind of market exposure. It's not technically true, but we do have strategies called 130-30 that incorporate some shorting within US equities. But generally speaking, we are more sensitive in our US equity portfolio to the market going up than hedge funds. That's why our allocation to own more in US equity and less in hedge funds over the last 10 years has benefited the plans and why the returns have been better than peers. But that's why in the fourth quarter, our greater sensitivity to the market, and the market went down significantly, our plan returns relative to peer returns were below the median. So that, again, is the biggest difference. You can see real estate, we have a little bit more, and cash, we have a little bit more. Happy to answer any more questions that you might have about the performance table at the top or the asset allocation at the bottom, but I would encourage you to focus and think more about the asset allocation of our plan and ask questions about why we have that allocation and how that helps achieve the goal. Because it is not an easy task to compare to peers because that information isn't always transparent, and even if it is, it might have changed by the time you're looking at it, and so you never know what you're, if that's what you're trying to be, you're never really sure what the objective is. Questions on this page? Or?
The amount in benefit payments, I'm sure that varies, but probably not very significantly. 145 million per year, is that pretty close?
Yeah.
Not the amount of benefit payments, but the amount of distributions necessary for benefit payments, so that the net between the contributions and what goes out.
Correct. That's better stated than I stated it, right?
Okay.
So that number is a net cash need. It's not just benefit payments. It's the intersection of the contribution, the benefit payments, and it's the need plus expenses of the plan. That number in a dollar amount, Sean may know better, but I think of it, I equate it more in percentage terms to the assets, and roughly it's been in the neighborhood of like 3%.
Okay,
right?
That's what I was thinking, 3.5 or so.
Yeah.
I've seen studies where it might make sense to hold a year's worth of distribution in cash, so you're not forced to sell securities in a down market. We're not holding that much in cash, we're holding 2%. Is there a reason why? Is it maybe a long run versus a short run? Or why is that?
So I agree with that thought. As I said before, liquidity is important. You won't see it here, but over the last year, cash started to inch up such that it's given us more return, and during the year, we increased it. During calendar year 2019, we increased it again. So there's two levels of cash within the plan. There's the allocation to STIP that as of 12/31 was 2%. When you get your January or February reports, you'll see closer to 2.5%. But also within CAP, there's a cash allocation of approximately 2%. So even if at 12/31, if you took the 2% and then you say, well, the other 2% in CAP, you multiply that by 0.98%, it's effectively 2%. We have more than 1 year's worth of a net cash need at this time. And that is, so that's not saying we're always gonna be there. At times we might hold more than that, especially if we got concerned about a recession or something and cash was paying us really well. And there are times over the last decade where we've held less, even at times maybe less than 1%. Because cash is the ideal for liquidity, but there's a lot of liquidity in our portfolio, right? We have a lot of exposure to US Treasuries, even public market equities, and we could liquidate those at any day. So it's not, but on the equity side, yeah, it's liquid, but those are the things that I don't want to be forced to sell during a down market. So I think we're in a really good position right now in cash. Over 2019, you may see that build a little bit, again, that's not because we want to set off the sirens and say, hey, a recession's coming, but it's more driven as the Fed raises rates, which we'll talk about later. It's paying us more. Right now, it's above 2%, and it might approach 3%, and it's okay to have 4 or 5% in cash in those type of situations when our goal is 7.5%. Any other questions on page 13? So I talked about most of the things already on page 14. The negative calendar year return, mid-single digits over a longer period, the longer term return since '94, peer returns. The actual results, again, will deviate, right? Although in actuarial assumptions and the investment consultant we have, they put out a number there and it's like, oh, that's gonna be smooth, right, for the next 10 or 40 years, but it's not, right? There's gonna be sometimes meaningful differences from those numbers. And I'm not trying to suggest that the investment consultant or the actuary don't expect that. They do. That's incorporated into what they take into account. But sometimes year to year it's a challenge because you say minus 2.64, that seems pretty far from 7.5. And in reality and statistical analysis, it's not that far. It's kind of within half of a standard deviation, right? And so actuaries and investment consultants will talk about standard deviations from an expected return, 1 and usually refer to 2 standard deviations. And so this difference isn't like a huge outlier. It's clearly within what would be expected. I will let you know though that 2018 was negative, particularly the fourth quarter. 2019, as of February 13th, we're up the plan approximately 5.5% year to date, calendar year to date. On a fiscal basis, it's closer to 1%, right? But the markets have significantly recovered in January and the first part of February, pretty much erasing what happened in December. Now, there's still more ground to cover before we get back to where we were, say, in late September. So this next section, and I'm gonna go through it pretty quickly because I don't wanna get too far into the weeds, but I wanna give you a sense. I mean, investments depend upon the fundamentals, what's going on in the underlying economy. So I'm gonna flip through these pages, but let me know if you have any questions. Generally, though, what you'll see, things are pretty good. The market, we didn't expect returns like we saw from the fourth quarter. Where we think a fair amount of that, we thought the market was fully priced going into the fourth quarter. It had been for a while, but as it sold off, people, we believe, panicked a little bit, right? It wasn't driven because, in the fourth quarter we entered a recession. Whereas if you go back to 2007, right, you can almost look when markets came off and then look when the government said, it entered a recession, and it was right near that time frame. Here, as we'll talk about these next few pages, in the US particular, but also globally, things are still pretty good. In the US, actually still at real high levels from an economic standpoint. So page 15 shows the length of the current expansion. And so this is looking at the fundamentals, the economy, not the market, right? So we're now, this left-hand slide of page 15 shows the 114 months. We're just about the longest economic expansion we've seen, right? And on the right-hand side, it's a little bit more difficult to see, but the key thing that I'd have you take away here, although our period's been longer, the difference here is the cumulative growth has been on average less each year, so it's been a slow climb. It's been a longer climb than usual, but a slow climb. And some people believe that is why it's been longer. It's because we haven't gone from a boom to bust type of scenario. It's been a gradual, and there's a lot of positive benefits with that. And it's why we don't think recessions are dead. The market doesn't think it. There will be downturns in the economy, but it's reasonable to expect today that our next downturn, which may occur in the next few years, may not be as deep as some of the past downturns. Because again, there's not a ton of excesses. Again, I'm not talking about the market itself. So there's difference between how the market prices things and actually what's going on. You can have a good business day to day. That doesn't mean it's a good stock to buy. So that there can, over time they're connected, but in shorter periods of time, days, quarters, years, there can be a disconnection there. Very good businesses could be very overvalued in the market. But the economy still seems to be in good shape within the US, and the current expansion continues. Page 16, some other things that describe the economy are also relatively good. The dark line here is the unemployment rate. We're like establishing new lows there, right? And people are trying to come up with explanations for that, right? Some people will question the validity of the number and say, well, not everyone's included, and there's a lot of technical things. But the reality is, yeah, not everyone's working, but we're at pretty good levels, right? And the bigger surprise here is this blue line, which is wages, wage growth. Wage growth for a number of years, go back to kind of the turn here after 08, 09, is starting to gradually go up. We would have expected that to increase a little bit more in past times. That would have gone up quicker as the unemployment rate came down. If you look at the black line, and even in you know, if you look at where this dashed blue line is, and you say, oh, when unemployment came down to about that level, wage growth was more at at that time, 4.1%. Now, we're heading in that direction, but in November 2018, it was closer to the low threes. That's important, right, because wage growth does influence the economy overall, and so that slower wage growth is probably something that has kept the economy going, but not this boom bust, right? And it's been more of a gradual. It's been another thing that's probably helped keep inflation low. So we view both of these things still as positives for the current fundamentals. On page 18, you'll see a little bit more about corporate profits, and on the left-hand side, it's really focusing on the operating earnings per share of the S&P 500. And again, things are good, right? The problem with the fourth quarter is that all that goodness was priced in, right? And then when more uncertainty came in, whether it was trade-related or geopolitical reasons or people thinking profits might come down a little bit, you know, the market, that's what caused the market to sell off. But on the right-hand side, even S&P profit margins are higher than you would expect. Now, that is high, the market generally expects, and part of the reason for the fourth quarter decline in the market was the market expects those will come down. One reason it will come down probably is because people expect wages will keep going up a little bit. And so more of the share of earnings will kind of go to labor than it was has gone the last few years to the equity holders. Any questions on kind of the US there and some Page 19, I included China because China is in the news as much in U.S. newspapers and influencing the U.S. markets as much as the U.S. And that's because of what's going on with China from a trade standpoint. But also, you know, China has been a growth engine globally in the world the last 20 years, right? And things are slowing down in China, and you can see that on the left, that general trend, you know, since '09 is coming down, but their GDP relative to the rest of the world is still a big number, right? And so, yeah, it's coming down, but that deacceleration is kind of hurting all these markets that benefit from China as a consumer of U.S. and other goods in the marketplace. So yes, they're slowing down, but probably over time that's good, right? That's more manageable. So that's not a bad thing, and although you might hear comments about, oh my goodness, the growth in China is collapsing. Well, yeah, from a 9% growth to a 6%, and it will probably go a little bit lower, that is significant, but that growth is still greater than the US, right? But it will have implications for business and markets. I'm not going to spend a lot of time on the right-hand slide, but like the U.S., you know, a lot of activities at the government and consumer level is debt related, right? And probably if you looked at China years and years ago, there wasn't much debt there. Now there is, and you know they're running their economy not too dissimilar from how we're running ours. You could see that the public debt and the household debt are well, you can't see it here, but they've been increasing, but still lower than the U.S. But the non-financial debt, corporate debt in China, is almost double, right? And there's some differences there, how their system's set up in their banking and the state-owned enterprises, so it's not exactly comparable, but it is something that we're focusing on. Page 20, so what are these key takeaways? Global economic growth, okay, it's slowing, but there's no prediction that it's going to be negative, you know, in 2019. Near full employment levels, that's one of the things that are keeping this slow growth growing. Inflation likely increase a little bit, but it will continue to be modest. The Federal Reserve is looking at those levels, and we're slightly below their long-term targets now. So even if it creeps up a little bit from here, you know, the market shouldn't panic and say, oh, the Fed's gonna raise rates. Yeah, they'll probably, if things remain good, gradually raise rates a little bit more, and we're not expecting that we're gonna go back to this term I used early in the presentation, normal rates. We're gonna go back from low two, you know, we're approaching 2.5 now in the Fed funds rate, where we're not expecting we're going back to 5 in the Fed funds rate, right? We might get to 3. If we get to 5, we're in a different world than we're thinking about today. This last bullet, we do expect politics within this country and outside the country to create a lot of this noise and uncertainty, right? And maybe over time impact the fundamentals of the business, and that's something we're always considering, but more likely it will impact the noise, right? And how people think about markets, and that's why we're thinking volatility will continue to be high in 2019. And when I say volatility, that's not always bad, right? January was volatile, but the markets went up. Fourth quarter 2018 was volatile, they went straight down, right? And so it's just, you hear a lot about efficient markets, right? And that's, you know, you won't see professors at the top business schools in the country talking about efficient markets and looking at the fourth quarter and the first quarter of this year. It just really can't be explained, right? If markets are priced efficiently, you should, with businesses not really changing, see that type of movement. There's a lot of psychology and behavior by, you know, people wanting to avoid downside. When markets went down, they sell, and that causes more downside. And you know, markets went up in January, people are like, oh my goodness, I got out at the wrong time. They get back in, right? And it's nothing to do with fundamentals. So, page 21, I've already talked about this. This is kind of how the Fed funds has evolved over time. It's now approaching 2.5. They're thinking it might go closer to 3. The market is hopeful that it's done, and maybe their next move later this year or next year is actually decreased. We'll see. That difference is one of the reasons in the fourth quarter and likely in 2019 we'll see markets be volatile because they're not on the same page. The next page just shows the treasury rates. The nominal 10-year treasury is the blue line, ended December at 269. As of this morning, it was at 268. So not real change since year end, but again, my earlier comments, you see from like the 80s here, it's pretty much been a trend downward. And as this line goes down, our expected returns on bonds, fixed income securities within the portfolio, their future return is declining. So that is why in the intermediate time period, we've seen some lower numbers in the portfolio because the upside from fixed income is not as great as, I'm not wishing for the 70s and 80s to come back, but there's good reason why interest rates were high at that time, and fixed income returns have benefited from interest rates coming down historically, but it made the future returns a little bit more challenging. Page 23 is the S&P 500, and here, again, you see the general trends. I'll give you an update here. I told you about the portfolio, but as of today, the S&P 500 price index this morning was at 2765. So year to date, it's up 10.3%. So in less than two months. Small caps, S&P is large caps, small caps are up 14.5% year to date. So it's a huge move in less than 2 months since January 1st. Our high back in September 20th here was at the level of 2,930 for the S&P. The low on on December 24th was at 2,351. So, you know, big gap between over that fourth quarter and those months, but we've retraced much of it, not all of it, year to date. I'm not going to spend a lot of time unless you have questions on 24, but I wanted to include this because this gets to the idea that I was saying before. You can have a good business, but it doesn't mean a good investment. And these valuation measures, when the values are high, and this is one estimate, when the PEs are high, it usually means that forward expected returns are likely going to be lower. And when they're low, maybe the future looks brighter. Unfortunately, you know, they go high, usually after very good periods of businesses and profits, and they're at low when everyone's like, oh my goodness, the world's crumbling, right? And so you can see the PEs were at the low, you know, around that 08 period. And you could see in the last few years, it kept trending up, and so part of this market sell-off that you see right at the end here on the right-hand side of the page was really a valuation drop. It was kind of more sentiment that people were saying, oh, you know, the markets have gotten overvalued. Page 25, this is that chart that shows that volatility as you go from left to right in longer time periods tends to reduce, and it's very unusual to see longer term returns for stocks be negative over a 20 or 30 year time frame, but not unusual to see negative 1 year or even 3 year time frames. So what is our strategy looking forward? We're going to stay in the asset allocation ranges. Valuations matter, so we care. Both how, not just over the next 10 years, what the averages might be, but where they are today. And so given those numbers, we're likely to continue, as we did last year, to reduce the public equity exposure in the portfolio, so U.S. equities, which again, as I noted, has been a very positive thing for the last 10 years, right? But we're kind of, if you think about all of our asset classes, we're diversifying a little bit more. We're flattening them out. Now, I'm not talking, hey, we're going to decrease U.S. equities by 10%. But even this year to date, as equities have been up 10%, we've kind of taken those gains and removed, in the process of removing it from U.S. equities slowly. So think of a neighborhood of, you know, 1% or 2, right? And if equities keep going up, we'll probably do that this year. We'll probably, you know, not let that percentage go up into the high 30s again. We'll probably keep it in the low 30s or maybe even the high 20s as U.S. equity as a percent of the overall portfolio. But that's not, we're not doing that saying we're predicting a recession or concern. It's just saying, hey, we believe the return expectations about these asset classes are flattening out, right? And therefore our portfolio should become a little bit flatter across the asset classes. But longer term, our bias, you see about 75% of the assets invested in equities today. Don't expect that to change in a very significant way. It might, again, if interest rates go up and if fixed income and cash has better returns, you might see that go to 70-30 or something in that neighborhood, but not. The only way where you're going to achieve the 7.5% return is with a long-term equity bias. The good thing is that over longer periods of time, equities have been, and we expect will be, the best performing asset class. The potential negative is the ride, right? Any 1 year, any 3 years, you know, it could, that equity weighting could produce more than a negative return. And then summary page here, I'll just let you read it, but if you have any questions for us, a lot of information on our website, always available to come down and speak to you. Happy to have any of you up to our offices to sit down and go over more specifics. Before I turn to the appendix, is there any questions? Anything I haven't covered that you expect or hoped I had covered you want me to address? So if not, in the appendix, I'll just point, this is a report that we send you each month now. You know, there's a little delay as we collect the information. In here is the report as of December 31st. So I'm now on page 28. I want to spend a minute or two to try to explain this, and because there's a lot of information here, it can get a little confusing, but hopefully, as you might look at this report going forward, make it more useful to you, and maybe the questions you have will help inform us how we can modify the report and better meet your needs going forward. But the top section on page 28, our first thing is really to focus on the asset allocation. And so here you'll see that the plan really has two major components: that allocation to the short-term investment pool, STIP, and the consolidated asset pension pool, CAP. And you can see, you know, for the non-accountants in the room, ignore the units. Ignore the unit value, just look at the market value, and the allocation is what I tend to focus on. So 2% in STIP and approximately 98% in this cap. So over time, again, when you get the February report, that 2% number in STIP will be closer to 2.5%. So that, if you're monitoring that, you'd be like, oh, cash is increasing a little bit. Again, that's all related to the return from cash and building that liquidity buffer, but not a huge change. Any questions on the top?
That's also affected though by any losses, the percentage. Because if you lose value in equities and you didn't lose any value in cash, you still have a higher percentage of the, right?
Correct, but there's actually, unless we have a huge loss, there's actually a bigger impact, because in the 2% of STIP, that's where we're paying out this net cash need every month. So almost every month, we're taking assets out of cap and replenishing STIP. Not a huge amount, but it might go down like this at the end of February. We might have 2.5% there as you pay benefit payments out. Maybe it goes down to like 2.3 or something, and then we'll get that back to 2.5. So we're always rebalancing, but you're right. These market value numbers are based upon how does the STIP return versus the cap return. And the more the cap return goes down, like in the fourth quarter, that boosts the STIP allocation up because they're market value weighted. The reverse is also true, and as cap goes up, it forces that up and kind of the STIP percentage down. But that's something we're looking at every day, but we're really rebalancing on usually on a monthly basis. There are some times we might do it within a month.
Part of my point to that also is why there's ranges.
Sure. Oh, right, yeah. I mean, and I think this is the benefit of the governance here in Montana. If you look at some other states, right, and if you sat in on their meeting, they have like, okay, our range for U.S. equity is 25.34%, and that is their target. And everything they do is to try to keep to that target. Well, there's a lot of cost involved as the market kind of keep doing that. And for us, we want to keep this longer term perspective, and we want to manage costs. So we're not promising to be at any number at any day. We're monitoring that and rebalancing to that, but keeping in mind the cost of rebalancing, right? But yeah, any market movement changes that, and that's a good reason why we have these ranges on the asset classes, but also we look at ranges throughout the whole structure of the portfolio. Any other questions or comments? The bottom half here is for those components to give you a sense of return. And maybe I'll start with CAP at the bottom here. There's CAP, those are the returns for those specific periods. You see we don't have a longer return for CAP because CAP as a consolidated pool just began, a few years ago, right? And you see that on the far right-hand side, the inception was April of 2017. So as we move forward in time and get a 3- and 5-year history, those will fill in. The benchmark for CAP, it says CAP custom benchmark, that's when we're looking at each of our asset classes, and each of them have a benchmark, and then based upon our actual weightings in those asset classes, we make up this custom benchmark. And so those asset classes roll up to be a CAP custom benchmark, and that's what we compare the plan to. Same thing is happening within STIP, but STIP has really just one benchmark. It's changed over time. We switched it recently from a LIBOR base to a US Treasury base, because LIBOR is technicality, it's going away, right, in the next year or two. But so that's why we switched the benchmark, but our old and new benchmark are very much connected, and it's cash, right? It's not a huge spectrum of, we're just talking different types of cash securities here. But you'll see that return relative to a short-term benchmark. And then the teacher's retirement plan is made up of those two components. So you should see the teacher's retirement plan return be between the short-term and the CAP return in most cases. And same thing for the teacher's retirement benchmark. That should be between those two other benchmarks. Again, benchmarks, we're tracking all this stuff and asking questions, why are we above, why are we below? It's probably not critical, for you to get overly kind of focused on it, and because, again, no, our primary focus is for those actual numbers, so that top line, teachers' retirement plan returns, and more important, as we go to the right, we want those numbers to approach the actuarial return. That is our focus. Page 29 just gives a little bit more detail at the next level down. It gives a sense of, for TRS, how many dollars are in each asset class, and then for each of those asset class, how many dollars in the overall CAP pool, and the last column, what are the percent, both for the TRS plan and for CAP, for each of the asset classes as of the end of reporting date in total. And then the returns below there are just for each asset class. So greater detail, happy to answer any questions, and if I were you, I'd ignore all the footnotes, right there. It's basically saying, oh, the benchmark was changed at this time and it's connected, but it's just going to add confusion. So if you really want to get into the footnotes, come over, or I'll come down here. We can dive into it, but nothing to get real concerned or spend a lot of time with. The key thing is to focus on that top page, the asset allocation between STIP and CAP, the mixture of the asset classes, and are the longer term plan. Is the longer term TRS plan return, how's that doing versus that actuarial return? So that was quick, going through a lot of detail there, but I want you to know that report is sent to you monthly. Any questions on that or suggestions for modifications?
The reports are great. I actually have one question on your very, very first slide with regard to
Table of contents?
No. Second slide. With regard to the prudent expert principle.
Yes.
Is that the standard that the board members are also under? Or do they delegate that to you as the executive director? How does that prudent expert principle work exactly?
This is a standard by mandate, legislative mandate, that is the expectations for the Board of Investments.
Okay.
So everyone on that org chart, from our 9 board members, executive director, everyone is trying to adhere to this standard. Now, the governance model and how we do that means that an accountant on the team versus an investment analyst compared to a board member, they're not all performing the same activities. But any activity that they're doing is the emphasis, are we acting in the best interest of the plan for the assets that we're managing? But the board's primary focus, the 9 board members are, do we have an appropriate asset allocation? So once a year, I'll be making a recommendation on that. But also once a year, the independent consultant, the consultant that reports directly to the board, RBK currently, is sharing their files. So that decision, asset allocation, the board is making that decision or approving the ranges that I would recommend, or not, right? And that is one of their bigger things to do to ensure that they're being prudent experts. The next thing that they do that's critical is policies, right? So we have policies for the retirement plans that include these asset allocation ranges, but also include more detailed investment guidelines. Like, oh, within real estate, you know, are we only gonna buy one property or one type of property? So there's more detail there. The board ultimately approves those and gets comfortable with that. So asset allocation policy and the management of our structure, not day to day, but overseeing stuff like budget, that's how the board really focuses on it. On a day-to-day basis, myself and the rest of the team are making sure, you know, the trains are running on schedule and doing things. So from someone on the investment team or the accounting team, we are doing individual security trades. The people on the team are deciding which managers we hire. We don't have managers come in for 15 minutes and sit in front of our board and ask our board to make that decision. We are taking from our board expectations about asset classes and what type of policies, and the staff is selecting managers. So collectively, we're all doing, thinking about the prudent expert principle and acting as fiduciaries for these plans, but what each person is doing is different.
I'd add a little bit to that. At each of the board meetings, there's a different segment of the individuals working, making the decisions, that they present to us the information they got, have they made the decision. Sometimes it's for our approval, mostly it's to show how they're following that policy, so we can understand that a little bit more and be able to look at that compared to RBK and approve or tweak these recommendations.
So it's a team effort, but with one mission in mind, of ultimately achieving these targets that you all, you know, establish for the actual return, but trying to do that in a prudent way. And so a big part of that is we're not just all about return, we're thinking about risk and how to get there longer term. Any other questions? Sean, anything that you think I missed or you wanted me to address?
No, I think you touched on all the main points that, you know, required to be statutorily. I don't have any questions. It's a great presentation.
Outside of your presentation,
Yeah.
and this is more for my benefit, or maybe the board's benefit as well, how much additional investment does the board do that's beyond pensions? Where your
Sure.
focus is different?
Yeah, so say we approximately have $18 billion total investments, about 10 to 11 billion, based upon whether you're using fourth quarter numbers or now, are pensions. So the majority is pensions. We then, and most of those dollars are in this cap pool. Your pension is also investing in STIP. That is a separate, distinct pool, the short-term investment pool. It does have pension dollars, but the vast majority of dollars in STIP are non-pension dollars. So there are other dollars from the state or local governments, and today that's probably in the neighborhood of an additional $3+ billion. And then the next pool is a trust fund investment pool. So this is a fixed income oriented pool that the state agencies participate in, and in most cases, we have an account, and like the pensions, that the pensions are investing in STIP and CAP, some of these other agencies, because they're not allowed to invest in equities, are investing in STIP and the trust fund investment pool. So again, that is, you know, a few billion. And then lastly, and I don't want to de-emphasize it because it's a critical part of the board, but just smaller in dollar amounts, we have very important loan programs that kind of benefit and work with either the economic development within the state or our InterCap program that, you know, supports kind of shorter term needs for different projects kind of around the state. And so, yeah, a lot is going on. Our organizational chart, if you revisit it, some of it's broken down, so that group doing loans is focused on it, but then we have like a fixed income team and a public markets equity team, a private team, an accounting team. So there's a lot in terms of those 18 billion and hopefully growing dollars. Does that answer your question?
It does.
Is the Montana Fixed Fund within the 457 plan? Do you manage that?
We do not.
Okay.
So,
Thanks.
you know, the largest fund that's in one of these state agencies, separate accounts that we manage is the state fund, the insurance, you know, work. So that we do allocations there. That is the only fund we have outside of pensions that has equity exposure, but it's very small. It's not, you know, it's more in the single digits compared to in the pensions, given what their specific needs and how they need to kind of run that business. But the defined contribution plans, so the 401k plans for the people in the state that participate in that, or the deferred comp in the 457 plans, are overseen by MPERA. And so there is someone, investment staff member for MBOI that participates on an advisory board that MPERA has. But today, that process for those defined contribution pension plans are separate and distinct from the defined benefit that we oversee. And the same thing, if you ever, you know, there's some other dollars, right, as you think about it. So we don't oversee the university endowments. We don't, there's some Viva healthcare type money, you know, we don't oversee that. So, but all those things, there's probably people in this room that could describe to me much more, you know, who oversees it and why they oversee it. I could just tell you we don't, and other people that have decided, you know, who will oversee that money. But whatever money we have, again, even the money that we're overseeing these accounts, we're not determining inflows and outflows, right? Like on the TRS plan, we take that from you, right? We're not opining on, oh, that's too much, that's not enough. We're fiduciaries for the assets that are in the account, right? And we're not trying to make, you know, many comments about where money's going to and the accounts that we don't manage, or we're solely focused on doing the best for those assets that we manage that have been put into the accounts that we're currently overseeing. Well, thank you very much for your time and your questions, and if there's anything I or others at MBOI that can do for you before we get together again this time next year, you know, please let us know.
Thank you for your thoughts.
Yeah, and just one thing real quick I wanted to mention, you know, on the monthly report we get, you know, Joe had offered when he started talking about them, if there's anything we want to see different or that, provide some of that feedback, and I wanted to remind the board that your feedback is incorporated into this one. This has changed quite a bit since the first draft of it, with Joe and I think Mike Pett there at BOI. They did a lot of work, they took our feedback because they're, you know, they weren't necessarily showing the benchmarks for some of these, you these asset classes and different things that we asked for that now are incorporated. I think it makes it a better report, so they've been real responsive to any of our requests that we have of DOI to step up and get it done for us.
Yeah, and I give Sean a lot of credit for, you know, partnering and helping us out there, because we're not with you that frequently, and so we don't know your needs. We can guess, right? But this is the report I showed you. To be blunt, we don't use it day to day, because we don't need to use it, right? So this report is for you. So as you want it to evolve, you know, I'm not saying we can flip a switch and get it there tomorrow, but we will evolve it to meet what your needs are. Yeah, we'll throw in these footnotes to clarify, you know, that there's not a misunderstanding what a number means or something like that, but it is your report, and would welcome, you know, any feedback or suggestions, and thank you to Sean for helping us evolve and hopefully meeting your needs.
Thank you very much.
Thank you.
Thank you.
Any public comment on
Yeah, thank you.
Okay, seeing none, we want to take a break, or do you want to jump in?
It's up to you. Well, I think if you wanna take a break, we'll have no problem catching back up. Garrett Bacon actually is not going to be here. I have a handout that, he sent me yesterday. Something came up, he can't make it, but he did send me some of his comments. And I'll hand those out to you, so we're not really tied to that 10:30.
Okay. Let's take a break then.
Okay.
Well, we'll call the meeting back to order. And call Mr. Brett secretary. Yeah, for us a little.
Chairman Dubs, members of the board. You'll have to excuse me, I'm feeling under the weather, which is tough to do today. The weather's been. So I'm gonna kind of go over the legislative audit report and the annual report. It doesn't look like everyone brought theirs, so that's okay. I'm not gonna spend a lot of time. If anyone ever has any questions on the annual report, you know, you're always welcome to call me. I prepare most of this myself with review from Tammy and Sean. So I kind of know it cover to cover for the most part, but so you know, the main things are like page 20 and 21 are gonna have your main financials, the statement of net position and the changes in net position, and those are kind of all explained in the notes that follow. If you have any questions on any of that stuff, there is you know, one new note disclosure this year on that. It was just a really big change to all the OPEB disclosure. And that mostly, the numbers in there mostly come from the state accounting division, unfortunately. So some of those, you know, if you have any questions on any of that, let us know, and we will answer those questions. The main thing is that it received an unmodified opinion again this year from the state, or from the legislative audit division. So the numbers in the report can all be relied upon by everyone who you know, chooses to look at that, the public. And we handed out the legislative, I guess, the legislative audit report, which includes the financials and the note disclosures and the required supplemental information that's in the annual report, but it also includes, you know, the legislative audit, kind of a brief synopsis of what they, you know, think are some of the highlights of the financials, and then some findings and recommendations. We had really two findings, one real finding, and then I guess kind of just a, you know, something that they wanted to mention, which was, you know, the first one, I'll just be brief, was that, you know, we have our I'm forgetting the term, our amortization period is over 31, or it's 31 years this year. So since in our funding policy, we try to keep our amortization period under 30 years, they, wanted to mention that we weren't, meeting our funding policy, but in our funding policy, it states that we, and Sean can speak more to this, but we, based, just without any changes, we will be under the 30 years, as long as the, assumptions are met in the future years. So we don't need to bring forward any legislation to increase contributions or anything, so if that's, just
Yep.
state that, okay? And then the second, the second recommendation, or the finding and recommendation was, I'm sure you're all aware of it by now, but it's on page 5 here of the report, 5 and 6, and it has to do with our supplemental contributions. We receive about 45, well, last year it was about 45 million in supplemental contributions from the state. We get a $25 million inflow, I guess, at the very beginning of the fiscal year on July 1st each year, and then we get the 2.38% from the general fund and the 0.11% for the from all of our employers. And I guess they being the legislative audit division, kind of latched on to one of our MCA, was it 1920-607?
Yeah, 605 and 607.
605 and 607, and 605 was the one that didn't have the.
No, 605 is the one that was amended in 2009.
Okay.
607 is the one that's missing counties and
Okay.
cooperatives.
So that we had broken out our employers by counties. We added the counties and cooperatives in the language in 605, but we did not in 607 at one point in 2009. Is that correct? And so therefore, even though the legislative audit division hadn't decided to make any findings on that in the 10 years since then, they did this year, that they recommended that we pay back the $2.7 million that we had been receiving supplemental contributions on from the general fund, for community college, for counties and cooperatives. And so I think that's in front of the House Appropriations Committee in House Bill 204 today. Or
It's
possibly.
sitting in that committee. They may take executive action today.
May take executive action today, so, and Sean will testify, that obviously our position, is that, yes, the law should be changed and we should add, those, employers, those specific employers into the 607, into the law. However, the intent was, going back to 2009, and has always been that we receive the supplemental contributions on all counties and cooperatives and all of our employers. Well, I guess other than the state agencies that already pay it on their own, so. I don't know if Sean has more to add to some of that, but
No.
that was the main finding, and we semi-concurred because we wanna change the law, but we definitely don't think we need to pay back the 2.7 million.
Yeah, I just feel, a couple comments I would have is that, first of all, it's an unmodified opinion, so they really don't have any findings. They have a recommendation, and they communicate an instance of non-compliance with our own funding policy, which was the amortization piece. And response as TRS is actually on page C1 of your report. It's towards the back, it's the very last section of the report, and you can see, like Norm just said, we did partially concur with their recommendation on the supplemental contribution. And the reason for that was, they had a three-part recommendation. It was A, B, and C. A was pay back the general fund 2.7 million. B was do that, and B, stop collecting the 2.38% from counties and co-ops. Or C, and it was important that it was an or C was seek legislation to fix this in the current legislature and make it retroactive. And that is exactly what we concurred with, was part C, and our corrective action was House Bill 204, as Norman just explained. And I'll talk more about that here during the legislative update. But I think, this is, I know every audit since I've been here has been unmodified opinion, and I know going prior to that, for a long time they were too. So,
Yeah.
I mean, Nolan and his staff are continuing to put out quality CAFR, and we're happy with that.
Just a quick comment back to the report. I really appreciate and like the distribution of the pages that shows where our retirees are collecting those funds.
That was the
Thought it was
last
quite
page.
interesting.
Yes.
Different countries, not only that, but the states and the actual states that they chose.
That's the map of.
Yeah,
Yeah.
the very back
And
page.
so that's actually, if you go to our homepage on our website, it's the bottom half of the homepage too.
Flip back one more page where
Yeah,
it's
it's got
actually
the
delineated out by
Right, yeah.
the state and country. I found that interesting.
Yeah.
I would hope, some people have different circumstances that I would have tax-wise going to some of those places.
Yeah.
Yeah,
Yeah.
yeah, think about 85% of the total benefits that we pay out stay in the state of Montana.
Wow.
Yeah, so, and just a final comment, we've received the GFOA certificate of achievement, that's what all these little plaques are. Actually, now they kind of just do the little button that you add to. But we received it in 2017, and this was sent, before the deadline, to receive it again for the 2018 report. But we don't usually receive those until sometime in the spring. So we'll see. I anticipate that we'll receive it again, but, so that kind of concludes my, annual financial reports, and if there's any questions from the board members on that, comments. So shifting gears to just, the regular, financial reports that we, that I present every, board meeting. These are as of January, 31st. And, of course, the market has, obviously experienced pretty, substantial downturn over the last few months. I should say before, we've recovered some, but definitely, before that. So you'll see kind of year over year, these are as of, January 31st of 19 and January 31st of 18. There's not a huge difference in total investments, year over year. And the total assets, are very close, year over year also. And that's just for the balance sheet information. The fund balance, though, you can really see the investment revenue, down significantly, as in comparison to where we were at as of, January 31st of 18, which kind of gives us our, a much larger negative, revenue over expenses than we had in the previous year. And that comes, is also obviously driven mostly on, if you look at page 52 on that, investment appreciation and depreciation, in this case, depreciation. So that's where that, is mostly driven from, is the depreciation in our, investments. And then the administrative expenses are obviously real similar, in comparison to last year. Any questions on the balance sheet, fund balance statement, or the revenue or expenses? So operating budget on page 53, you know, we're a little over halfway through the fiscal year, and we anticipate, you know, having a surplus. You know, obviously anything can happen in between now and then, but it would have to be pretty significant for us not to have at least some surplus towards the end of the fiscal year at this point. The M Trust Phase 3 budget, we're getting closer to about 10 months roughly remaining on the project. We still anticipate to have a budget surplus at the end of this project, so we shouldn't need to, even if the project were to extend a month or so, I think we'd have enough money that we've already been budgeted. 55 and 56 are just kind of informational. That's one of our main expenses is contracted services, and kind of see, you know, where those funds are being spent. And then we haven't had any delinquent agencies, you know, as of their, I guess it would be their December reports, because their January reports aren't due until, well, today would be the day that, the last day for them to get their January reports in is February 15th, so I haven't checked if there's anybody who hasn't turned in their January reports yet, but it does have been pretty, you know, our employers have been pretty diligent.
Oh, that's actually really good. There's a bill draft up there this session to modify the penalty interest, or how the penalty is calculated for late pension payments to a para. So they have a few employers that have gone, you know, more than a year without reporting any compensation for their employees, which is just, I mean, really a disservice to their employee. And I mean, if they happen to be a DC member, that money, you know, they'll never even make that up. I mean, they're not gonna calculate some amount to put in that member's account that it would have earned or possibly lost, you know, on any of the investment returns in a DC plan. So it's really good that, you know, I think the most we ever see on this delinquent agency is maybe 3, you know, 2 to 3 school districts, and usually within a month, Nolan and the accounting staff get those cleaned up. So I guess just kind of, so you're all aware, I mean, that's not necessarily the norm when you look at our counterpart over at PERS. I mean, they have some real challenges getting some of their employers to report. And the weird thing about it is some of them are school districts that are reporting to us, but they're not getting the reports into them, so.
And members of the board, that's all I had, unless you have any questions about any of the annual reports, audit findings, or the financials and budgets here today.
Thank you, Nolan.
Thanks.
Appreciate it. The next item is the personnel committee report. And this morning, Janice and I met with Jim Kearns and of course Sean to go over his appraisal and review his self-appraisal, staff input, board input, and review all of that. Since I'm the new member of that team this morning, I'll turn that over to Janet, so she can say a few things, and then I'll jump in.
The thing I was most pleased with was the input that we got a year ago from the staff and the comments that they made, where there were areas of concern. Those concerns did not, for the most part, ever show up again on this year. So I think that Sean is taking that input to heart, and I appreciate the fact that when somebody gives him a suggestion, he does follow up on that. But overall, the scores between what the board was coming up with and what the staff they were very comparable and very impressive scores. We are pleased with the job Sean is doing.
I think the thing that impressed me as much as anything else this morning was, especially when you look at the staff input, the level of, when you're talking about a 4 being a performance most of the time versus a 5, which is all of the time, and you've got average scores from the staff that are between 4 and 5 on every item. That speaks pretty highly of where the staff views the executive director, and that doesn't happen every year. So I certainly think, Janice is correct, I think Sean took an awful lot of that information from previous years and acted on that, and that's a part of what we're seeing. But I also think it's also a reflection of the position he's in now as his 5th year as the executive director. You get to 4 or 5 years, you're starting to get your arms around the position and the employees that you're working with, and it's starting to be reflective of the direction the system is going in and your leadership. And his leadership marks were outstanding, both on the part of the board and the staff. I certainly think we're very fortunate to have Sean is our executive director, and I think his ratings show that from everybody. And there are several categories, I won't go into those too much, but obviously strategic plan for me is one of those areas that's really important, as are some of the other areas of networking with comparable agencies and member groups, as well as his work in the legislature, which sometimes seems to get forgotten about, but is not forgotten by the board at all. And there's an awful lot of reports that happens with the legislative year and his work with administration. So, for those of you that see Sean's activities during this part of the year, by taking a little extra time and watching some of those hearings, you start to understand just how important his actions are to the system and how valuable they are to those decision makers outside of the system. He's very well respected. So with that,
That's enough about me. Thank you, I appreciate it, because like Scott and Janice both said, I do actually value the staff, not so much the ratings as much as the comments. There's a lot of good information in those comments, and they're all scrubbed as they should be, so I can't tell who they're coming from, but it does point me in the right direction for areas that need to be addressed. So there's some value, I think, in having an appraisal like that.
I would say one more thing about the process. I've been on the board for a long time, and this process probably started 12 to 15 years ago. I've been on several other boards that work with an executive director, and I've also worked in schools forever, obviously tied to school boards. And I think the process that this system uses to provide input from both staff and board is better than I've seen anywhere else, and I think is more meaningful to everybody involved, especially in terms of helping the executive director and staff move down the road and address some of those really important items that that we're supposed to be about. So I would, I'd certainly encourage continued use of the performance assessment appraisal system that we've got and how that fits into the process. So with that, any comments from others? All right, let's jump to the tentative meeting. Next one's scheduled for May 10th. Is that an okay date for everybody? I hope so.
So I believe Dan Chamberlain can make it on the 10th, and as far as I know, Carrie can make it on the 10th as well.
Good. Okay, and then, obviously the other ones are a little more tentative, but I think they provide some pretty good direction. And I believe that 11th one is probably
Yes,
in
that's
October.
That's what the thing I was going to mention is October 11th. That we'll schedule ahead of time with the actuary to come present the results of the valuation, and we do that in coordination with the Impera meeting so that they come out from Montana once and not have to come back a week later.
And that's October 11th.
Yeah. And I've already confirmed that date with the Kavanaugh building.
Good. Out-of-state travel requests, and this is an action item. Do those first.
Sure, so, Mr. Chairman and members of the board, on pages 57, 58, and 59 of your packet, these are the written travel request and justification for Denise to attend a Napa summer conference, for John Noble to attend the prison annual conference, and for myself to attend the NCTR directors meeting. As far as the budget authority for these three conferences, they've already been approved in the current year's budget, because that was in May essentially, but we always bring with a specific request to the meeting ahead of the actual travel, to get the out-of-state travel just approval from the board. If there are any other questions, I'd be happy to answer them.
I move to approve all three.
Is there a second? Okay. Janice and Dan? Any discussion? I would just mention that I think those opportunities are very valuable for staff. Any questions or discussion? Seeing none, all those in favor say aye.
Aye.
Those opposed, the same. Chair votes aye. At this point, I think we've already talked about the next meeting date. Is there anything specific you want to mention about that?
No, up above on the Indeed, there's still tentative, I guess, and then if you were to have made a change, you would make it known here, but since you didn't make a change, I think it's okay.
Okay, good enough. Any public comment on the administrative business? Awesome. Park Avenue lease terms.
So, Mr. Chairman, unfortunately, Garrett Bacon, who had planned on being here in person, is not able to make our meeting, so I'm gonna pass around a copy of an email that is based, kind of his synopsis of the comments he was going to provide to the board. You both still have the copy of the email? Okay. Pass this out over here. So I think what I'll do is I'll start by hitting the high points of the document that I just passed out. Can I have one? Thank you. And then we'll get into the release itself. But Garrett, Mr. Bacon, who is what's his title? It's the Senior Leasing Officer and Real Property Manager for the state of Montana. So Garrett Bacon is in charge of negotiating leases and getting them drafted and signed by all the appropriate parties for all of the state government in the state of Montana. So he handles every lease, essentially, that the state government enters into. And so what I had asked him was, he had worked on the draft of the lease terms that you have in your packet behind tab 5 here. And he comes up with the shell, and then there was some negotiations that had to occur between myself and the director at the Board of Investments, and there were some modifications that were made. But what I wanted Garrett to hear for was to speak to, in general, is that the terms of this lease that we have in front of us, are they reasonable? Are they fair to the retirement system? Those kinds of things. And so you can see in his comments, he says the state currently has 4 leases in that same building. A little over 7,000 square feet at $18.25 per square foot, and that's an 8-year lease with no escalator. However, when we get down below, you'll see as those leases come up for renewal, they're all going to have a 3% escalator in that building. Another lease is $14,686 at $20.17 per square foot. That was a 17-year lease with a 2% escalator. A third one is 9,600 square feet at $18.38 per square foot. That's a 6-year lease. We didn't include whether there's an escalator there or not. And then the final one is almost 11,000 square foot at nearly $19 per square foot. And that's a 10-year note was that, because of an escalator freeze in past years, all leases will have a 3% escalator when they come up for renewal. And that freeze really was in the tail end of the recession. Governor Schweitzer did implement a freeze on some of those escalators. And every landlord in town is going to bring it forward when they renew leases, it will have a 3% escalator. Then he goes on to state that we've entered into 7 20-year leases for different agencies here in Helena and more across the state. 20 years is the maximum that we're allowed to do without legislative approval. The TRS BOI lease will begin at $14 per square foot for 2 years without an escalator. And as I stated in my write-up, part of the reason for us getting a reduced rate those first couple of years is to help offset the cost of modifications we need in that building before we move in. And then he says, beginning July 1, 2021, the rate will increase to 1936, which will be lower than most of the existing lease rates at that time. The 2018 market rental rate in Helena for comparable space is $20, considering CPI of approximately 3%. The 2021 market rental rate can be expected to be $21.85. So we are, I believe, getting a fair deal to move there.
Will we have an escalator on the 1936?
We will. So beginning, the first 2 years, it's frozen at 14. Once we start in beginning July 1, 2021, from that point forward, there'll be a 3% escalator.
And that's inclusive of all the cleaning fees and all that business we were talking
That's all
about.
for here. Yeah, it's all included in that PUI lease. Then
Just
probably
still
the.
can't believe they charge. It's just-
What? What's
I
that?
still can't believe they charge that.
Well, I know, it's annoying to me too, trust me. The next piece is probably, it was our biggest point of contention, and Denise drafted the language that we ended up putting in this lease agreement. Typically, the only out they put in a lease like that is a non-appropriation clause, which means if the legislature doesn't appropriate enough funds for you to pay your lease payments, you potentially can get out of your lease. Well, that doesn't really do TRS any good at all, because we're not appropriated to begin with. So we did successfully twisted Dan's arm a few times. We did get a termination by the lessee without cause addition to this lease agreement. So basically what it means is we're locked in for the first 5 years, essentially. But then after that, as long as we provide 2 years notice, we can get out of that lease for any cause. Without penalty.
Or for another one.
Or for the. And then in summary, Garrett just says the TRS BOI leases at a very reasonable rate, quality space, and prime location. So that's his comments. Beyond that, the actual lease agreement is included within your packet, along with a drawing of how the space would be configured on the last page. It is a 19-year lease. I know that seems like a long time, but if we're going to spend somewhere in the neighborhood of $100,000 or $150,000 on modifications in that building, I don't think we want to have any thought of moving out there anytime soon anyway. The longer term does a couple things. We know exactly what our costs are going to be for quite some time. In fact, 19 years from now, I should be pretty close to being retired, I hope. But we'll see. But it does provide some level of security. We put money into that building to move there, and the cost of moving there, all that, it provides some level of security that they can't kick us out 5 years later.
Parking and everything that they're offering, is that kind of sufficient?
So there's,
for you guys?
we would get 8 covered parking spots underneath the building that we would be in, 6 surface parking spots, which is 14, and of course we have a staff of 21. So there will be some, we will have to pay for these, but we will pay for some parking spots across the street, and depending on whoever's parking over there, it's their preference. It can be covered if they park in the first level down, or they can park at the top level. But yeah, we will have a little bit of additional cost related to for some spots across the street. And then of course the visitor parking is designated for all visitors of that building, whether they're TRS or PRS or healthcare benefits, doesn't matter. There's quite a few visitor spots in that first row.
The way the schematics, is the one door into the kind of reception the only way that anybody other than employees can get into this space?
So that would be the main entrance. Now, the day of a board meeting, if you look way down over on the left-hand side, you see that where it says new alcove. This is on the final page in that section of your, page 78. Where it says new alcove, there's actually an entrance door there as well, and it's kind of a little, that alcove is just a little, kind of receiving area, for lack of a better word. And then the board room is right there. So we would put up, we actually already have a nice retractable TRS sign that we'll put up, on the day of the meeting. So that the main entrance, they would come in, they would take that right-hand turn. This is all on the ground level of the building. They would be able to clearly see where the board meeting is, and even if not, if they check in at the front desk, it's simple to send them down the hall. They can come sit in the board meeting. It's nice to have that little alcove available, because then when we get to the disability section of our meeting, we'll still be able to close the meeting down and have chairs there.
So essentially, those are the only days that that door though would be open? And so
No, I think
you're
it
gonna
would
funnel-
be, for the public, yes.
Right, that's
The
what I
public would always come through that reception area door, other than the day of a board meeting. Now, staff would have access to enter that
So
door.
I could keep that, right?
Yeah, and then there's another door in the
Just
middle.
wanna make sure everything's kind of secure for you. and not
Yeah.
Anybody, since it's ground floor,
No, no,
walking
yeah, no,
in and coming in anywhere they
definitely.
want.
Staff would have, whether we end up with card readers, or I think currently what's there is like a keypad, a combination pad. Staff would have access to that door, and then there's also a door in the middle,
Right.
that would lead out, and you can see the restrooms right across from there. We had talked about removing that door, trying to make that room, meeting room bigger, but actually, if you're in the middle of this suite, it's kind of a long ways to get to the exits for restrooms, so we left that.
I suspect for fire codes, they probably wouldn't have wanted you to remove that either.
Possibly, yeah.
So the parking lot's at the top of this picture and the street's at the bottom? No. The opposite, parking lot's on this side.
So there's underground parking right underneath this, where the suite is, so that's where 8 of those spots would be. The parking lot, the main parking lot would be at the top of this page. On the bottom of the page would be Park Avenue, and then the parking garage would be
I
on
got
the
it
other
now,
side.
that's where they walk in.
Yep. So, Mr. Chairman, members of the board, we've been talking about, we've looked very closely at moving into that building previously. This is actually better space, it's all contiguous, connected space. We're getting it actually at a better rate, about $4 a square foot less than we would have been paying previously. Now, with that, I'll address probably what are some of your questions as far as, what does that mean for the building we're currently in. So the House Bill 5 proposal is making its way through the legislature. We are seeking $550,000 to remodel this building. Now, if we know we're not moving back into this building, the cost to remodel this building is gonna go down significantly, because over $100,000 of that 550 was added on at the end, and it was, not an afterthought. That's not a good way to characterize it, but it's something we didn't think about initially, was to put in a lift, essentially a wheelchair lift between floors. If we're not coming back here, and technically speaking, the building needs, it's up to code as far as access for downstairs. I mean, that's $100,000 I would say we're not gonna spend on a remodel. And there are a few other things, like this boardroom. Part of the cost is to move this boardroom downstairs, split this current boardroom into 2 offices. Those are discussions I would have, we'd be willing to have with the agency that's coming in, because they may as well have some say on how it's configured. But there may be some opportunity to save some money, remodel will cost money there, and then it takes us less time to recoup it that way. But I guess the point I'm trying to get at is, I am already in negotiations with another division of Department of Public Health, who is interested in, having the lease already figured out and essentially ready to sign, so when this building's remodeled, that we can move in right away, and we would start to, have a revenue stream as a landlord of this building.
And the lease price would reflect the fact that they didn't pay for the remodel.
That's correct, so the lease price that they would end up having would be, somewhere in $18 to $19 per square foot from day one with a 3% escalator built in. I would have it mirror essentially the DOI lease, with the exception being that we would start them at $14 a square foot because we're fronting the money for the remodel. With that, I guess the only thing I can really tell the board otherwise is, I had talked to Carrie several months ago about, the possibility, Carrie, Chair Pfeiffer, I should say, about the possibility of there being space in Park Avenue again, and I asked her, I said, I don't wanna get out in front of the board too much, and I just touched base with her, and she said, we've been talking about this for 2 years, go for it. So I think I've been able to secure favorable terms for TRS. Obviously, we're not locked into anything yet, but I do have an actual lease agreement with 3 out of 5 signatures already complete, and those signatures on that lease agreement right now. I haven't signed it yet, but once I do, then we'll go to the new budget director for approval. So we are that far along if the board is comfortable moving forward.
I think it's the ability to get out of the lease if we decide to after 5 years. I think there's no question it's probably the best thing to do.
Well, and I think it addresses several of the concerns that we had when we started the process 2 years ago, and I also think we've had enough discussion. The board is comfortable with the direction that we're heading.
Yeah, I think the only thing that still kind of hurts me is the money that we pay for maintenance.
Yeah.
And that will continue to be on our dime, right? Even regardless of what, we can add to the lease or something.
At least in the foreseeable future, it will. We will be charging somewhere around $19 a square foot for this space. We'll be turning around and sending somewhere around $10.60 or $10.50 per square foot to GSD. That's the current arrangement. I have, on several occasions, made sort of idle threats to the General Services Division that, why do I have to pay this? I mean, we can hire a property manager just like DOI does for around $2.50 or $3 a square foot to do pretty much all the same things, and you just send us our own power bill. So there's a possibility that down the road I could really play hardball with them on that. It's just one of those things where it's been going on now for over 20 years, and you talk to them about it, and we're built into their rate structure, and in some respects, what really is going on is we're subsidizing other state agencies. And that's not in the best interest of the teachers' retirement system either, so.
So we don't pay the utilities we're all in at the 19,
That's correct.
or at the 14. Yep.
Mr. Chair.
Any questions from the public?
No, Diane Sodmo, MFPE. I would just like to make a couple of comments. I think in terms of staff space and what you need, this building is not adequate for the spaces that many of your staff members have. Just aren't suitable for the quality and the caliber of work that I've seen your staff do. They've worked through it, but I think more staff room and a nice location would be a good thing for your staff and your staff morale. So that's one reason that I support this for you. The other is the opportunities that I see for potential collaboration with Impera. I'm thinking in closer space. Impera, for example, has had an auditor. And their auditor just listened to the reports yesterday, and they're able to help their employers understand the issues and correct their errors before someone is going to retire years later and those issues are found another way, which is very frustrating. You've heard my points before that I'd like to see this board have room to grow for that position perhaps. And I see that there could be potentially calendar collaboration between Ampera and this board in terms of managing that schedule and serving employers well. I think Darla's work and communications could fit very nicely with what I've seen Ampera do. But I think being in the same building space would allow better collaboration and outcomes for both systems. So, for those reasons and Sean's great negotiating skills against the Board of Investments, whom I think would be also a good landlord. I'm in support of this. I don't like losing you as a neighbor, but I think for the good of the agency, I think it's a smart move and a good move. So thank you for the opportunity.
Is there 22 offices with one being shared, so 23 potential workspaces here?
Yes.
And we have 21 employees, so we can
Yeah.
afford two.
Yeah, there would be room for two, and then another thing I'd point out is there are a couple of these, and I will make this, crystal clear to staff as when we move in there. There are a few of these offices up front, it's hard to kind of read, they're E115 and E116 especially, that are actually quite large, and it would be no problem at all to put, there's plenty of room to put in a cubicle wall inside the office and separate that space, and you could potentially have two people in both of those. We wouldn't need to initially, but we certainly would have room to do that in the future. And then as well, it's a 19-year lease, and 15 years from now, if for some reason the space, right next to where the reception is, that's currently, I think, occupied by the Department of Labor. There's that end, as well as the far end, all the way on the left-hand side of your page. There are additional spaces available that could potentially come open in the future. They're not available to us right now, but at least there's the potential for that to be available to us in the future. We don't need it right now either. So.
Yeah. That'd be great. I see strong arm general services and.
Is that in the motion?
Ideally, they would have, and maybe this happens at some point in the future. The Department of Administration really should own this building instead of TRS at some point. I mean, that would be ideal. It's in the middle of the state capitol complex. It's not as simple as we just put a for sale sign on it, because I think we would get an awful lot of blowback if we tried to do that. However, there may be opportunity in the future, even if this building is leased out, for the state of Montana to purchase it from us.
So I would move that we move forward with the lease at Park.
Is there a second to?
Second.
Thank you, Matt. Discussion. Discussion already?
Yeah.
Any discussion? Seeing none, we will now vote on that motion to approve the lease of those terms. All those in favor say aye.
Aye.
All those opposed, the same. Seeing none, the chair votes aye. Mr. Graham.
Okay, so we're on agenda item number 6, Executive Director's Report. The first piece is staff update, and it's a pretty short and sweet update this time around. We have had no changes since our last meeting, and I would point out that at our last meeting, I notified the board that there was a little bit of musical chairs going on as a result of Sandy Donahue's retirement. That prompted several people changing positions within TRS, all internal appointments other than Christian Ward, who's now out front, which you met him last meeting. But everyone, as far as I know, and I've keep pretty close tabs on this stuff. All of those individuals that are now in new roles are all performing quite well and are meeting our expectations up to this point. So that's all good news. Item B is 2019 legislation update. So I provided you a write-up as of last week, February 7th, where our housekeeping bill, which is House Bill 204, is at House Bill 337 is the supplemental university bill, and then Senate Bill 139 is Senator Lang's return to work bill. So the update to those updates are our House Bill 204 is sitting currently in House Appropriations. It's possible, and in fact, it's probable that they'll take executive action on that bill this afternoon at 3 o'clock. There is an amendment already drafted. I've reviewed it. Denise and I have both have reviewed the amendment. And what the amendment would do is take House Bill 204 back to the way it was when it went to the House floor. So we would be certainly in favor of that amendment because it does away with the $2 million haircut to our $25 million transfer. So hopefully, I'm hopeful that that committee will, House Appropriations will put that amendment back on the bill to return it to its previous form. The Democrats on the committee are certainly in favor of doing that, and I believe, at least as of 2 days ago, there are a couple of influential Republicans on the committee that were in favor as well. The only problem is until the vote's actually done, you never know for sure what will happen. So I don't have a plan to go up there this afternoon and be available for any questions that anyone on that committee has. House Bill 337, since I wrote this, actually we had the hearing, I believe, on Monday or Tuesday, the 12th, whichever day that was. Must have been Tuesday of this week in House State Administration. Representative Lynch again carried this bill on our behalf. You know, the bill had a good hearing. I had several questions about, you know, what happens if this never gets paid off. Of course, the answer is if MUS isn't ever really taken to task on this and made to pay it off, what happens is it gets distributed to all of our other TRS employers in the state of Montana. They're the ones that end up paying off that liability. There may be, I mean, certainly not this session, at an $18 million a year price tag, it's gonna be hard for this bill to ever pass. I know this board has discussed it previously, and then I also had Representative Heyman, you know, come up to me and just after the hearing, she ran into me a few days later, and she said, you know, I think you really gotta come up with a different approach. I mean, it's too expensive the way it is. They're never gonna do anything with it if you keep bringing it in at full bore, you know, the full amount. We're required to bring a bill to make recommendations to the legislature. I think so I guess where I'm going with this is, maybe the right approach next time is to, we have the actuary determine, and they will, it's part of that report. What's the dollar amount necessary to do it, to get it all, right? And then, that's just information I provide, and maybe what our bill does is actually ratchet up the 4.72 by 0.25% per year or something for 8 years or something. I don't know, I mean, we may as well take a stab at trying to get some additional funding. I mean, as soon as you start jumping in 1% or more increments, I think the legislature is just gonna continue to say, well, that immediately results in tuition increases, we're not doing it. So, it's something to think about. I mean, obviously we have 2 years, I just wanted to kind of throw that out there.
Well, what's already baked into our analysis is that it stays where it's at forever.
That's correct.
So any incremental movement we get is some benefit to us.
That's correct. Now, part of I think what we all have to be mindful of is, yes, our current assumption is we continue to receive that 4.72% forever. But if all of our other assumptions are met and we actually are 100% funded in 2030, I have to imagine that not 2030, that would be nice.
Yeah, I was gonna say, very
30 years
optimistic.
out, right? So 2049, okay. So, I mean, I think 2033, which is the date that the university system liability is supposed to be paid off, I think that will come and go, and probably without a whole lot of fanfare, unless we're down to like when we amortize in 10 years. At that point, you might see the university system talk somebody into bringing a bill to do away with that contribution. I mean, I think we all have to recognize that if we really ever do get 100% funded, because that liability is rolled into our unfunded liability, they're gonna.
And we looked at what our funded ratio or the number of years to amortization is with it gone.
Not with it gone, but it's about 11 million a year and about 300,000 a year in ongoing makes up about a 1 year difference, so it would be significant. I'm sure it would add at least, at least 10 years, if not more, for amortization period. I know if they were to increase the contribution up to the 11.89%, to actually pay it off by 2033, it reduces our amortization period by 6 years. Wow. Or 5 years, excuse me, it goes from 31 to 26. So, like I said, I just wanted to get that out there as something for us to, think about, in the interim between now and the next session. It's just getting so expensive because that 2033 never changes. Every 2 years, we're 2 years closer. So it's just one of those. There's no way they're going to be a higher increase. And then the final bill that I have listed here is Senate Bill 139, which is Senator Mike Lang's return to work bill. This bill is actually had some action taken on it day before yesterday. So it passed out of Senate Education with an amendment to it. So instead of going from 30 to 25 for the years necessary to be eligible to work in this provision, it's now been changed to from 30 to 27 years. They reduced, originally Lang wanted to go from making available for 4 years during a person's lifetime instead of 3. That has also been amended now so that it's back to 3, so you can do 27 years to do it, and then available up to 3 years during a person's lifetime. And then another change to the language that they did in Senate Ed is that they are now going to exclude superintendents as being the positions that can use this provision. I think right now it says teachers, specialists, or school administrators. So right within 1927-32, they're defining school administrators as basically all administrators except for superintendents. So it would make it to where if their title really was superintendent, they would be able to work under this provision. I don't know.
Principals still could.
Principals.
Yeah, principals could
I
absolutely.
don't know how much sense that makes. It's the
Yeah.
same thing.
In those little tiny districts, they're mostly principal.
Well, they're,
I mean, we
Yeah,
play with the
yeah.
title, right? I think you can play with the title easy enough in certain places.
Little Pryor has a superintendent and 2 other administrators. So it's by no means the case.
Right.
Same with Lang.
So, up to this point, TRS has not been a party to any of the amendments, any of the changes. Our position has been that we're opposed to any expansion of this statute. And even with these amendments out of Senate Ed, I think that my recommendation to the legislative committee, we haven't had a chance to actually meet via phone call since these changes. My recommendation would be that we continue to be opposed to any change to this statute. I think, I have to imagine that school administrators and possibly School Boards Association is not going to be in favor of them removing superintendents out of this, but who knows? I think if we get a little bit more opposition than just TRS and our friends down the street, we might be able to kill the bill and leave statute the way it is my hope.
I concur with you. I think we can go for it.
I think, I've mentioned my thoughts several other times, but if you're not going to include funding in any change of benefits, I think it's a bad bill, number one. And in this scenario, I think it opens the door down the line to all kinds of other problems, including potential tier 2 people now being eligible to retire early based on language, and there's just a bunch of issues associated with this thing. I think we're better off if we're going to push for any change in that, we make it clear that it's only tier 1 people and that it's, that there's funding associated with it. So I don't see any change in that position.
Yeah.
And I would assume, you directed me on another thing with this bill earlier this month, but I would assume probably a quarter of the ones that we have are superintendents right now.
I would say that's pretty close to being accurate. Yeah. If you look at the list, if they really have been using it as it's intended to be used for emergency situations where they couldn't find anyone, if removing superintendents, you're taking out 25% at least of how it's been used in the last 10 years. I mean, is that the right thing to do? I mean, I kind of don't think so. Okay, that is my legislative update. Within your packet, there's a higher level summary that is available on our website. There's nothing new. I mean, it's our House bill, our housekeeping bill, excuse me, House Bill 204 hasn't really changed much at all since you first looked at it about a year ago now. The University System Supplemental Bill is pretty straightforward. You all understand that. And then, of course, the Langs Bill. Those are the three bills that are in play that could affect TRS at this point.
Are there any other retirement type bills that, while they might not be directly influencing retiree behaviors, that might be of interest?
So like I said earlier today, I think I mentioned, there's a bill that could potentially adjust the penalty for employer contributions coming in late to Impera. I mean, there could be implications to TRS, you know, at some point down the road if they did adjust that. I don't think there necessarily will be. I think Impera's rule is it's whichever's greater, whether it's either $10 a day penalty or, you know, something around their actual rate of return. You know, we charge interest at the actual rate of return. So theirs is similar to that, but for really small balances where just the flat interest rate ends up being less than $10 a day, they tack on the $10 a day. So I don't necessarily see them pulling us into that, but that's potentially something that they could look at us at in the future too. What else? Oh, the game wardens bill is out there. That's a funding request. It actually had legs. It got out of state admin. At one point, they amended it to make the employee contribution go up to 11% to match the employer contribution increase, which is a 2% increase. Then it was amended to come off, to take that off, so that the employee was going to be slightly less than the employer. That's the only current system in state government where the employee pays a higher contribution rate than the employer, and it's by a couple percentage points, so it's quite a bit. I heard, and I haven't got to go look, but I got a text at 5:30 yesterday that the game wardens bill was amended again in House of Probes and is likely now dead. I don't know, did they vote out of committee?
I'll just offer. What I understand too is that they amended it to put back on that contribution.
Right.
And then put it in the folder. Now, that doesn't mean it can't come back, but it was,
Okay.
you know, because it wasn't in the governor's budget, it's a tough one. And there is a, you know, $800,000 a year cost on that, so we'll see what happens when we end the session. Last year we revised it, but one of the things they did last year is move it up to a 25-year system as a part of the negotiations that they out. So
Yeah.
we're watching it, and we'll continue to watch it and decide if there's, what happens with appropriations really matter. Does it look like there are some things that didn't get funded, so there might actually be money? Well, that would be interesting, and then we'll see. But the changes to that system are difficult. It's some of our lower paid folks in the state, and it's a 20-year system, and so that seems to work well for corrections and game wardens, and so we'd like to see without that extra employee contribution. They've been paying more since 2002. So if it doesn't come out the right way, it shouldn't come out.
Right. Beyond that, Mr. Chairman, there's the deadline for general bills, I believe, is next Friday. So there's nothing else currently drafted. We'll be watching that closely, right, Denise? I mean, there's a few, we monitor a lot of bills, but there's not really anything else.
We usually get one where they just kill them all.
You know, they used to. We haven't had one of those last several sessions, knock on wood. I don't necessarily want to go have to chase one of those around, but yeah, it's been good essentially since 13, since the fix. So that's my legislative update.
Any public comment on
No additional comments, stay the course.
Thank you very much. Okay, legal counsel?
Thank you, Mr. Chair, members of the board. Again, still, only case we have, contested matter we have going on, or at least judicial review of a contested matter now, is the Zabrocki matter. If you recall, we filed this petition for judicial review in early December, following the board's final determination. Maybe early December is incorrect. Anyway, we timely filed this petition for judicial review following the board's final determination. I filed a motion for the board to set a briefing schedule and oral arguments in the case. Otherwise, the court simply looks at the administrative record in the case, and the review is limited to the administrative record as well. But given the number of unusual issues that have been raised in this case through its 7 or 8 year history so far, I wanted to be sure that we had briefing done and oral arguments before the court issued its final decision. Mr. Zabrocki filed 2 preliminary motions, one to stay execution of the administrative determination. So we notified Mr. Zabrocki that his benefit would be modified, actuarially adjusted downward to account for the unpaid member contributions and overpaid benefits that he had received. That change in benefit was accomplished with the October benefit payment to him. He filed a motion to stay execution of the agency decision pending determination on judicial review. We of course opposed that motion. He also filed a motion to join the school district as a necessary party because he believes the responsibility for paying his unpaid member contributions lies with the school district. He may absolutely be correct on that point, but we oppose the motion as well, because if they're responsible on an indemnification basis and not because legally the retirement system can collect those funds from them. Sean and I were in a hearing a week ago yesterday on those motions. We received the court's order on both motions on Wednesday, and they were both denied. So unless Zabrocki tries to directly appeal those 2 things, then the benefit adjustment remains in place, and the school district is not joined as a party on judicial review. So again, no final scheduling order, briefing schedule, and oral argument schedule has been issued. So I can't tell you what the overall time frame looks like, but that's where it stands at this point. Again, because there's still a possibility that some portion of the case would be remanded to this board and or to the hearings examiner through the board. The prohibition on ex parte communications remains in effect. I can tell you what the procedural status of the case is, but neither Sean nor I can talk about the facts or the law with you, so if you have any questions about that, again, Mike Kaufman is being kept up to date on the filings in the case, and if you have questions, you can contact him. So, unless there are any questions, there's, again, nothing legal going on.
Other than that.
Yeah.
Other than the same old stuff.
Right.
And I expect next year at this time I'll be giving you a similar update.
One of those spared offices, Dan, is for this Rocky files.
I was looking, when you mentioned there were a couple of large offices that could
Yeah.
be cut down, I'm thinking, geez, I hope one of those isn't mine, because I got
Filing
lots of
cabinets.
boxes.
Okay, thank you, Denise. Applications and benefit adjustments are listed in your packet under,
Mr. Chair, members of the board,
Since December 1st through January 31st, we've processed 25 applications for retirement from disability to early regular retirement. So it's, again, a slower time of year for us, but it's about to change, as always.
Yes.
Yes. This time of year, every year, we send out about, almost close to 300 applications. And we keep a listing of people that want to have, anticipating retiring. And then as soon as we get an updated W-4P form, we then do a mass mailing of those applications. So it's around close to 300 every year. So it will change soon.
May I ask you a question?
Yes, sir.
On a couple of these, it seems that there's a retroactive date to termination. So was this probably just age-related and they waited until this time to
We
start?
have term
collecting
vested
those?
members that, the stuff stays on file and then we retroactive pay them back to, the first of the month following age 60 or the first of the month following termination, whichever is applicable.
All right, so those are the age 60.
Yeah,
I
60,
thought so.
yeah, or, it's just their term vested, not necessarily age 60, but they're terminated vested, they deferred their retirement or left the monies on deposit here until at some point in time they make the decision. Yeah.
And part of that is spurred by the kind of work our staff is doing,
Doing,
where
yeah.
they'll run that term vested letters and they,
Reminding them,
we
right?
let
Yeah.
them know, look, you have this
Yeah.
money here, you're retirement eligible.
Sure.
Yeah, we have a 180-day process of the system. It's not automated. At some point in time, we may get to that point where we're in the middle of every month. We run the 180-day process and it looks back and sees how many individuals have been reported over the last 180 days. It gives them a listing of those individuals, whether they're vested or non-vested. And then the appropriate material is sent out to those individuals, whether it be just an application for withdrawal because they're not vested,
Right.
or truly giving them estimates and an application.
So I'm glad they took advantage of whatever.
Yeah,
Yeah, absolutely.
absolutely. Yep,
Absolutely. Thank you, Tammy.
you betcha.
Any questions? Seeing none. Long-range plan. We'll do it all of that today.
We have been doing a little of that. So, Mr. Chairman, members of the board, there really hasn't been any updates to any of these items other than the main one that we have going on at this point in time is the building, the workspace, and, obviously we already had that discussion. I think we'll have the opportunity, for sure, between now and August, we're not gonna get any real progress on the workflow project or workflow, I'm not sure project's the right word for it, but, at some point, we're going to want to try to put every single process, form at TRS into an actual dictated and laid out workflow that utilizes the scanning and Perceptive, the content management system, and map all the workflow, that will move that all the way through the office so that we're not passing around paper folders. It's all gonna happen electronically. That is something that's one of the longer term goals of the system that we wanna get to, but we're not gonna get to it between now and August for sure. So I think it's something we can discuss more at that point in time. When, Tammy and I will put some more thought into what we think our approach should be to that. We have implemented the first piece of it with the online beneficiary designations that we're doing now in Mtrust. That is really kind of a first crack at workflow where you have, rather than the member sending us a paper form, they're interacting with our system online, and it creates a PDF form that then routes through the office and ends up in imaging. So we have we're starting to gain a little bit of experience in this area, but I think we can, number one, do a lot of it ourselves if we bite it off in reasonable chunks and not say we're gonna have every single process is gonna be done in a 6-month time period. If that's the case, we need to hire about 10 people to come in here and do it. But I think if we get through the Mtrust Phase 3 project, which is scheduled to be done in November or December of this year, I think we want a little decompression period for some staff that have been working on that project for 7 years at this point. And then I think we can plan strategically for that, Darla has continued to update and put out videos. So she has successfully videotaped our Ready, Set, Retire presentation for this year. It's available on our website. She actually gives the mid-year or mid-career TRS 101 presentation, and that has been videoed, and that's available on our website now. And the way that she's doing it is actually kind of neat. And Darla, maybe you can help me explain this better, but you can really see she sort of superimposes herself if she's talking, or Janelle if she's talking, into like the presentation, so you can really see the presentation good. It's not like you're trying to look at it from a video camera from 50 feet away. You can really read the slides well, and you can hear. Do you want to maybe just mention how you do that?
Sure. The first time we did this last January, I guess it was, in the auditorium here at Helen Middle School. It was really dark. The screen was really dark, so all I did was make a graphic of each slide and superimpose it over the video, so it's nice and clear. And then I can control if John has advanced the slide, but she's still talking about the previous slide. I just don't change the graphic so that it's always in sync. So it's pretty cool.
Yeah, they really have turned out pretty nice. I mean, so those are available at any, our members can go and watch them anytime that's convenient for them. We'll get sort of random requests here and there, especially this time of year. It's like, hey, in fact, we just got one this week. Can you come to Colstrip? We have five or six people that are thinking about retiring. Well, no, we can't pick up and get there tomorrow, but we have this video available on our website, and actually there's about 15 of them, so we're going to do a webinar for them, which we do some of that this time of year. We provide webinars for the Ready, Set, Retire presentation. We try to accommodate, but it's not always practical if it's only one or two people, and we have all that same information saved off as a video that they can go watch. That's a more efficient way to deliver information. So.
Well, and I think the other real advantage, or to those people you never hear from or you never know anything about, they can just browse around and look
Right.
and which is really what you want.
Yes, they can educate themselves. If as long as we have all the information out there and available, I think a lot of them are pretty good at doing some level of that, educating themselves.
Is there any type of counter on those videos to keep track of how often they are?
They're on YouTube, so there is. It's hard to know if it's one of us looking at it or.
Right, but it gives you an idea.
Yeah. And you might have an entire room full of people watching too.
I did send out the TRS 101 on our Facebook page, and that triggered quite a few views. So.
Right, so for all the members, I think we've talked about it a little bit in previous meetings, but the TRS 101 is geared towards some more of a new member or mid-career training. And so Darla, with the help of the active staff, developed that presentation and actually gave it in person at the educator conference. And then you did one here recently too, wasn't it, here in Helena? So we could
January.
in January here in Helena, so we could get that videotaped. But I think that was pretty well received at the educator conference from the because the Ready, Set, Retire really it's good information for everyone, but it's more for in your last 5 years, where this other one's a bit more of this is kind of the benefit of what this defined benefit plan is, and gives more of an education.
The crowd was huge at the conference, which told us people want that. So.
Yeah. It has been every time I've ever gone to it.
So with that, Mr. Chairman, there really isn't a whole lot of new things for me to update the board on. Are there any questions from members of the board?
Thank you for that update. That's good information. Any? I don't think we're getting no public comment, so. Why don't we, it's our early, why don't we just continue on?
I was gonna say the my disability, no one, will find it continue, it's not, attend.
So let's close the meeting for Okay, we'll call the meeting back to order for action on our disability applications. Is there a motion for?
I'm sorry, Mr.
I'm sorry, go ahead.
I'll just put on the record that with respect to applicant Kevin Conwell, member Janice Mueller has a personal and long-term employment history with Mr. Conwell that could give rise to an appearance of a conflict of interest. Therefore, she will abstain from conversation and voting on his application.
Thank you. Our first request is Nancy Anderson. Is there a motion?
Move approval.
Been moved and seconded. Any discussion? Seeing none, all those in favor say aye. Aye. All those opposed, same. Chairman votes aye. Our second disability request, Mr. Kevin Conwell. Chair would entertain a motion.
Second.
It's been moved and seconded to approve the disability request. All those in favor say aye. All those opposed, the same. Chair votes aye. And our third disability request, Todd Schatz.
I move to approve.
Second.
It's been moved and seconded to approve Mr. Schatz's disability request. All those in favor say aye.
Aye.
All those opposed, the same. Chair votes aye. And how do we want to proceed? Do we want to jump right into the training, or do we want to?
So, Mr. Chairman, one of the concerns ran out of the room here, our sandwiches are here, so we could potentially, take a short break and did you order a sandwich?
I did, but I can
Yeah,
train
so-
you guys while you
okay,
eat.
well, I was gonna say,
I'm not worried
we could
about
Can
it.
you train us what?
Eat your sandwich and then
No.
maybe start the training, quite a bit sooner than what this schedule says.
Let's take a short break.
Meeting's called to order.
Mr. Chair, members of the board. This is the time in the agenda for board training on TRS's policy of non-discrimination in employment and provision of services. We go through this every year. For any of you that remember or may not remember, this training is sort of required to be conducted every year, both with respect to the board members and the rest of our TRS staff, because of the governmental code of fair practices and case law that has arisen under that. And we are deemed not to be fully compliant with that particular Human Rights Act under Montana law if we don't do regular staff training and that on the requirements. I had told Sean a week or so ago that I was going to try to, it gets a little boring to just keep going over the policies on these policy training sometimes, but I was going to look and see if I could find some exciting new case law or that you would really think that there would be a plethora of new case law and sexual harassment claims, that sort of thing, over the last couple of years. And to be honest with you, I don't find anything terribly, those things are happening not at the EEOC level or human rights level for the most part. They're happening in just flat out employment discrimination or sexual harassment claims. Certainly no new case law under Montana law that is new or unusual. So I will tell you that, and the policy points out that by adoption of this policy, TRS adopts the statewide EEO non-discrimination and harassment prevention policy that's set out in the MOM policies and an administrative rule in the state of Montana. So one of the things that we've discussed in the past as well is that Montana human rights policy and policy, non-discrimination policy applicable to state agencies, the Montana Human Rights Bureau's, the Montana Human Rights Law is broader than the federal law with respect to the classes of people that it protects. for example, age discrimination under Montana law is, you can discriminate on somebody at any age. If age is improperly a basis for a determination that you make, it can be illegal age discrimination. Under federal law, age discrimination applies typically at age 40 and higher. So unless somebody is 40 years of age, you can't discriminate against them on an age basis. So there's a little bit of difference there. We also, state agencies operate under a slightly different standard because there is currently an executive order in effect that makes sexual orientation a protected class. It is not currently covered under state law, nor is it covered under federal law. There's actually introduced just yesterday, maybe the day before yesterday, House Bill 465 by Kim Abbott, which is expanding the state's human rights law to include sexual orientation, which is the subject matter of the executive order at this point, and gender identity and gender expression. So people who either live as a person of the opposite gender from what they were born, or people who dress or behave as if they belong in the gender opposite of what gender they were born. And these days, even what gender somebody is born under is not entirely required to be pinned down and specified. So suffice to say, particularly if this bill, and I will tell you, I'm not sure if this bill will pass. We won't go into a long, detailed discussion about why that might be the case. The state legislature recently addressed adding these same categories to their rules, legislative rules regarding non-discrimination in legislative processes. And it's terrible for me to tell you that they considered that in their rules and not be able to tell you what their conclusion was, but at this point I don't know what their conclusion was. I do know there was a lot of pushback to adding these categories to the legislative rules. So can't tell you whether the legislation will pass or not. Suffice to say, I think it would be absolutely accurate to report to you that the teacher's retirement system would view discrimination on the basis of sexual orientation, gender identity, or gender expression to be improper as well. Did I be correct?
I guess
So, pardon?
I would hope.
So with or without it being included, but I will throw out that that is certainly, you know, whether or not they are included in the state law, you know, we expanded, and it was on the recommendation or request of one of our board members, we added sexual orientation to our policy as well, and we certainly could expand our policy to include gender identity and gender expression as well, you know, whether or not the statute passes. So the Code of Fair Practice, the Governmental Code of Fair Practices, and our human rights policy apply both to us as an employer of TRS staff and as a provider of services to our membership. And the Governmental Code of Fair Practices expressly applies in both arenas. So the policy applies both in our day-to-day plan operations with respect to our staff, in our hiring practices, and in the provision of services to our members. Our policy prohibits us from taking into consideration anybody's protected class status, and the protected classes, again, are specified, and it's not just somebody's actual status. If you perceive somebody as belonging to a protected class and treat them improperly based simply on your perception of them belonging to a protected class, it's still illegal discrimination, and subject to both our policy and state law. So we recruit, appoint, assign, train, evaluate, and promote personnel on the basis of merit and qualifications without regard to anybody's actual or perceived protected class status. And we provide services to the public only with regard to the individual's qualifications for services and benefits, and without regard for protected class status, except to the extent that protected class status like age, disability, mental or physical disability has a bearing on their right to benefits or services from the retirement system. And of course, we're a retirement system, so both age and disability applications for retirement, and that it can clearly be an appropriate factor we take into consideration. We don't allow and we do not retaliate against any individual because the individual has opposed discriminatory practice or because they have filed a complaint or participated in a complaint against the retirement system. Fortunately, in all of the time that I've been here, we have had no complaints. We've never had to prove that we don't retaliate, but I'm quite confident that we don't have the type of culture here or the type of administrative oversight that would ever allow that to occur. Again, TRS number 6 on page 2, TRS will develop and implement a program for non-discrimination training of all TRS personnel. Again, that's required for us to be fully compliant with state human rights law. And I think you were indicated, in the past we've had staff come in and do training along with the board to do it all at one time. There's just not the space with the number of staff we have to get everybody together in the boardroom for that. Staff training on both the non-discrimination policy and the annual ethics training will occur next week unless I'm on jury duty. So we do I conduct personally a periodic review of applicable law to find out whether anything has changed. Before we do this training every year, I review to see if there have been any changes to state law or state policy in the human rights arena that would require modification of our policy. If that ever arises, certainly you will see that, not just in training, but in those revisions to our policy. For TRS purposes, again, we just have very little basis to tell you how things work. Policy is how things will work. We just don't ever have cause to test that at this point beyond the annual training, etc. We do provide instruction and policy to staff members about how to make a complaint. Certainly people can make a complaint here internally. They can go to the Human Resources Office at Department of Admin. By law, they can go directly to the Human Rights Bureau or to the Federal EEO office to file a complaint if it's under the statute that they're, and the Human Resources Office at Department of Admin would help them determine that if they needed assistance, because there are some violations. For example, sexual orientation violations would not be taken to the Federal EEO office because the federal law does not protect based on sexual orientation. So, any questions? Anybody have any? So, would anybody suggest to me if there is specific topics in human rights that you would like to have training on rather than simply going through the policy next year at this time? Is there anything that, even as far as training of TRS staff, any areas that you think are particularly valid for consideration or training or? I know it's hard to say. You know, it's easy to sort of look at what's going on culturally at this point and say that, you know, sexual harassment training might be particularly relevant and particularly valid, but truly in the culture that we have here, I'm not sure that it's, you know, particularly necessary. But if you feel strongly that certain topics should be,
You know, the only thing I would say about it, I think there are videos and some other things that are really good, but they need to be pertinent to the culture of what's going on in the building. If there's like no real connection as to why you would see that, it's not worth time to spend.
right,
That's a good point.
I did like your idea of trying to find, you know, complaint and then walking through that. a little
yeah, yeah.
To see
And
their perspective.
And the Human Rights Bureau here, you know, they put out a number of opinions every month, a number of decisions every month. But I could not find one in the last couple of years that was sort of an unusual or new twist or, you know, nothing out of the ordinary, so it's, not necessarily needing to go through a case summary if it's not providing
Yeah.
any new information either.
Sure, there's plenty of time between now and then if we come up with that.
Exactly, absolutely. And so for any of the training that we do, the ethics training, all of that kind of stuff, if you hear something, if you know, any of the conferences or that you go to and want to do, a more in-depth review of it here for conflict of interest, you know, anything along those lines, we can certainly do that.
Okay. Any more comments or questions? Thank you, guys. One of the reasons why we may not have complaints is because we talk about this.
Potentially. We will have all staff next week. I think Wednesday.
Wednesday next week.
You know, really, and this can, I mean, we can be finished here, but really and truly, it is the atmosphere in a workplace where, you know, it's just people by and large behave very professionally in this building all the way around, and I would be shocked for us to ever really encounter, you know, in the sexual harassment realm, issues here. Certainly, you know, the greatest risk may be in employment, hiring, that sort of thing, but even at that, I just see it. We don't have much more conversation when we get the staff together about these issues, so that's a good thing.
Yeah, it's probably a bad thing if all of a sudden a bunch of stuff comes up.
Yeah.
Well, at this point in time, Chair would accept the motion to adjourn.
So moved.
It's been moved and seconded, all in favor, say aye.
Aye.
Aye. All opposed?
Great.
All right.